rip up the script here. We're so advanced. Mona Mahajan with us with her computer work at Wharton. And we come, we're rolling Philadelphia today.
Oh, I know, big time.
You leave your school and you leave it behind. Jody Lurie nailed it. She's really done a lot for Bryn Mawr down in Philadelphia. We're thrilled she could join us in studio this morning. We're going to talk travel in that. But you are the queen at Bloomberg of corporate credit. When you see tech new issuance, like Facebook, Amazon, and the rest, how do you treat $1 gazillion billion of credit?
I kind of laugh a little bit about this, Tom, because, I sit right near Rob and he just gets so excited, but it's comical because then he just writes about how much cash they have and how much cash they continue to have. And then I look at my companies.
Yes, you have to look at credit agencies.
Exactly. And it's exciting that they're generating cash, my companies, after a few years of just generating nothing. So it's really such a dichotomy when I look at his companies and I just see the billions and billions and billions that they're just sitting on, and they're just deciding what to do.
But you're a pro at this. You've been doing this. You've sat on a trading desk with Janney, and you can't move the paper. Do you worry that it's someday you can't move Mark Zuckerberg's debt?
I mean, I'm going to leave it up to Rob on that one, because I think that Facebook or Meta is a very interesting company. It's had a very long ride, but it's definitely more of Rob's turf than mine at this point.
Well, you are all in Philadelphia, aren't you?
I am all in Philadelphia. All in Philadelphia.
But no Philadelphia person, Tom, can tell me what a mummer is.
Oh, I can tell you what a mummer is.
Okay, go.
Yeah, the Mummers Day Parade. So the mummers are these weird people who wear jingles on their knees and their arms, and
Those
they dress
are
up in
Eagles
these.
fans.
Yeah, it is Eagles fans. I mean, they're one and the same, but they dress up in these elaborate costumes. They partake in libations a little bit too heavily, and they have this humongous parade on New Year's Day. It's quite a riot.
Only a girl from Bryn Mawr can get libations and humongous into the same sentence. Facebook, 2.7% debt. That's how much expansion he has.
Yep, he can do it more.
With Jody Lurie here with the breaking news, Kurt Wagner with this incredibly important story. Zuckerberg pulls back from metaverse. Is that right, Paul?
Yep.
Did I capture that?
I think so.
And Jody Lurie on the bond team looking at corporate credit for Bloomberg. Thrilled to have her after Mona Mahajan. Paul Sweeney.
Jody, you look at a lot of the travel companies, the cruise ships, the fun stuff. What's the travel outlook for 2026?
So when you talk about Mark Zuckerberg, I mean, I know he has a handle in Hawaii, right?
Yep.
What we're seeing is kind of interesting. We're seeing a tale of two stories, where you have the lowest income consumer and the highest income consumer. So that K-shaped economy really is playing out. So we're seeing that 41% of the lowest income, so we're talking, $50,000 and less in self-reported income, annual income, are expecting to take 1 to 0 trips next year, whereas it's about half of that for the others. And you're looking at the 150,000 and above, and they're willing to put way more cash to their budget if their costs exceed budget. And it's a kind of obvious answer, except for the fact that if you compare it to last year, we're seeing much more, excitement, or much more of a strong conviction around spending or not spending on the two polar sides of the equation.
Well, I'm literally, as we speak, I'm texting back with my Summit Dad ski group, and we're planning our trip. And people are actually pushing back on costs this year for the first time. I'm like, people, man up here. We're going to Aspen. We're going to have to pay through the nose.
This is
but
important.
It's being pushed back.
And Paul, this is a really important insight, because Jody, I would say our chat is on airplanes, but the pushback is on lodging. Am I right on that?
And that is spot on. So people they want to pay for premium. They want to pay for the upscale. They want to pay for the more expensive experiences. But if costs exceed budget, guess where they're cutting? They're cutting in accommodations, and they're cutting in experiences. They're going for low cost or free experiences. Okay. Whereas they still want to travel in luxuries. They still want to do the higher end planes. And we're seeing that play out in the data. I mean, I know you've had George Ferguson on here a lot, and he's talked about the dichotomy between Delta and Frontier, just to give two polar opposites, where Delta is saying that their customers, which are, more luxury customers, are doing well. But then the Frontier customers, it's a little bit spottier. And what's really interesting is if you dig a little deeper into the data, we were having some fun slicing and dicing the data yesterday. If you look at that cohort of younger males and you see what they care about, unsurprisingly, they care about Wi-Fi and they care about snacks on their plane. That's priority, way above everybody else. It's sort of comical. But what they also care about is they don't care as much about having a direct flight as the rest of the cohort.
Right.
They're willing to go on that layover. They're willing to get stopped in the airport. But everybody else wants to go direct. Everybody else wants to be treated like a king.
Yeah, Paul's group is old fart ski trip.
Yeah.
You know,
So you're doing Frontier.
That's a young cohort as well. Okay, I'm looking at the Capuano bond out 10 years. This is Marriott.
Yes.
Good morning, Anthony Capuano. Love to have Tony in as well. Now they had a bond glitch where the price went down to 96, but it's migrated 96 to 103, or even on a moving average basis, it's up a solid 4% total return on a 10-year piece at Marriott. There's an appetite for this stuff, right? What does that signal to you?
And what's interesting about that, Tom, is we've seen from this morning, they're actually talking at a conference this morning, and they said that their RevPAR is going to be down a little bit, and their
Revenue per available room.
Correct. Their revenue per
Lisa, I got
room
that.
might be a little bit on the lower end, and their occupancy rates might be a little bit on the lower end. So they're signaling that 2025 might end not as strong, or it's going to end a little bit on the lower end of what they expected. But when you think about a Marriott, and you think about a Hyatt, you think about a Hilton, in my opinion, Hyatt, and this is what we've talked about a bunch, is Hyatt is well positioned because they've really gone all in into the all-inclusives, right, with their recent acquisitions. They've also stuck to the higher end consumer, and they've teamed up with all these independent hotels, which is sort of a complement or a competition to the Airbnbs of the world. So I think what we're seeing now is that we're seeing that Hyatt, Wynn, those sort of companies are still doing well because of that K-shaped. Whereas if you look at Hilton, we talked about this a few weeks ago, you could draw a line where the mid-tier and lower was and how much worse that did last quarter.
How about the cruising biz? I think about the day one of the pandemic, all your cruise companies were hitting the market, raising cash. Very smart, very smart. How's the cruise business these days?
They are doing pretty well. I mean, they've experienced quite a few upgrades recently. You know, Royal Caribbean is solidly investment grade now. Carnival is working its way there. You know, it's got Fitch on its back, and now it's just waiting on one of the other two. It's, you know, crossing its fingers. Right. And what we're seeing is these companies really have stuck to the deleveraging, but they're now at the point where they say, okay, we've gotten our balance sheets in good shape and we're generating enough cash flow that we're willing to give back to shareholders. So we're going to see that the story might be less exciting from a credit perspective, but it's much more of the normal pre-pandemic level.
Off your desk, Jody Lurie, is there any room for discussion of preferred debt or convertible debt?
Love it.
Are we getting nuances here?
So it's comical because James Crombie on the news team, he still remembers that I used to write about converts and preferreds all the time, and he'll message me occasionally about some of them. You know, I think I used to go deep into busted converts quite a bit. And I think the problem when you look at the convertible space is it's just shrunk so much. It's not what it used to be.
It's not what
it's really
you're
tiny.
You're too young to remember what it used to be. But the answer is it's not what why is it not what it used to be?
Because there isn't the appetite for converts the same way. I mean, the only companies that really issue converts, when you think about it, is the companies that need people to invest in them and they need some sort of carrot. Right? So it's the venture capital type companies that are trying to raise capital, and they're trying to do it in a way that's cost efficient. Now we have the private markets that are much larger, and Dave Havens actually just put out a deep dive on the private markets, which I recommend you guys reading about.
We don't read deep dives. You don't have time for deep. I
mean, it's 50 pages of good stuff.
Can you send that to me?
Pretty pictures.
Can I ask one ugly question?
Yeah, go.
Jody Lurie, I'm just fascinated. Your thoughts on 2026, away from your remit, private credit. Mm-hmm. What are you going to watch for in private credit?
I think I'm just going to watch for everything else everything that everybody else is watching. I mean, I think for me, the question I have is at what point does private credit become public? You know, the same way that we see that public has sort of migrated to private, right? It used to be that 144A issuance was very rare, right? The institutional investor issuance wasn't so common. Now the mom and pop investor can't just go buy a Marriott bond. They have to buy it through a fund, right? They have to buy a 144A bond. Right. Most bonds are 144A for life. So we're now at this point where you say, okay, public isn't really public so much anymore. Private might start being not so private anymore. At what point are they one and the same?
All right.
Okay, we got to run.
Fine,
This has been almost a special edition of Bloomberg Surveillance with this